Okay, well, welcome everyone. Thank you very much for joining this Meet the Gurus. Today is more of a fireside chat. I'm going to jump deep into demystifying finance and banking on some level. Obviously, I sort of describe this as trying to describe the mechanics of a Ferrari by putting it on a post-it note. So the idea is that it's quite detailed, it's quite broad and deep. And so what I'm going to start out with is some very basic definitions of what's going on in the finance world. Not today, but this is kind of like a primer, and if you will. So let's see if we can jump into some slides that might be helpful. I should have put myself in these slides, but for the moment I'm just going to put my voice. Okay, so let's talk about what is banking and finance demystified. So what is a financial services company? Well, let's look at the definition from Investopedia, just as a very simplistic way of looking at this. A financial institution, and they are called FIs in the finance world. An FI is a company engaged in the business of dealing with financial and monetary transactions such as deposits, loans, investments, and currency exchange. So it involves everyone pretty much on planet Earth. Consumers, small businesses, medium businesses, global organizations, large organizations. These can be regional, national, or international. Multinational, it used to be called. Financial institutions themselves are part of the ecosystem, as are governments, believe it or not, and agencies. So let me talk a little about each of these for a moment, because, before I do, I just want to sort of get back to a little screen with me here, which is what are the roles that each plays in this kind of ecosystem. So every one of us knows that we consume all sorts of financial services, we buy things, and they serve anything from our auto loans, our home loans, our credit cards. Now we exchange information. It used to be called a wire transfer. Now it's a Venmo, instant transaction, all brought about by fintech. Financial institutions look at consumers as core to their businesses. Now, why? Well, consumers are the less expensive or least expensive cost of credit. What does that mean? Or capital, rather. So if you put your money in a bank, you're likely to demand the least cost of any institution. Financial institutions are much more sophisticated, so when they lend money to each other, they're usually lending it at a higher rate. Okay, so the consumer has the least cost of capital. So why do banks maintain retail branches? So they can actually acquire deposits, one of the least costs of capital. Obviously, that's one part of their business, acquiring capital through a regional or a local bank, and obviously an online bank as well. But one of the primary things that they do is to provide services, fee-based income. We all know that when we go to an ATM, most of our own ATMs at our own financial institutions are free, but when you use an ATM from another bank, you get charged a fee, and that fee is shared between your bank and the bank that you bank at. But of course, there's all sorts of offsets, and you may not get charged anything. That bank may not charge you anything. So your bank may reimburse that other bank because it was a service to you. So that's a very small example of how a bank might make money. A bank makes money because you decide to do a wire transfer, another simple example. But what they're really looking to do is provide other services, whether it's it's an auto loan, or it's a credit card, or other fees. Because if you think about it just for a minute, let's just use a $3 fee on a $100 withdrawal from a bank. What just happened? The bank just charged you 3%. But how long did it lend you that money for? It didn't. It gave you your own money. So it basically has a near infinite return. The only cost to the bank was storing the bills in that ATM. So banks love fee-based businesses because the cost of capital is typically very low, and the returns are very high. So all of the things you see banks moving towards in the consumer level are fee-based business. Now, let me talk a little about these other businesses. And I say a bank, I'm just talking about a financial institution of any type, because there are numerous types of financial institutions, and we'll get to that in a moment, because consumers are served by insurance companies. Consumers are served by fintech companies that are also financial services organizations. But let's talk about small and medium-sized businesses, okay, and large businesses. You know, where does a bank serve a small business? Now, I'd say a bank because I'm just going to focus on that for the moment. Most people don't know. Now, if you're a business banker, those are bankers that are dealing with smaller to medium-sized companies, depending on the size of the financial institution. A regional bank, let's say Regions Bank, or a super regional bank, let's say like PNC Bank, I'm talking about the United States, or a global bank, let's jump to Europe, like Royal Bank of Scotland or HSBC. They have different categorizations of what they describe their tiers of banking, that small, medium, and large size organization. So let's use an example. A small organization, let's say my local California or Washington-based bank, they might consider a Umpqua Bank, let's use an example, it's based in Oregon and in Seattle. That bank may consider a small business up to $5 million in sales. Now, HSBC, a global bank, doesn't have the resources to consider that a small business. They might consider $0 to $25 million. And I mean sales. This is sales volume. This is how financial institutions often categorize their client base. Now, where is that organization, HSBC in this case, or Royal Bank of Scotland, or Deutsche Bank, or National Australia Bank, or KBC in Belgium, where are these organizations going to service these people? Well, when you walk into the branch, you might meet someone, the teller of course, or you might meet someone sitting at a desk. That person sitting at the desk is typically not the business banker. They're a person dealing with a retail branch, or what they call the retail platform. So those are people that you would talk about opening an account, talk about a wire transfer, talking about an auto loan, all the things I just discussed. But typically a business banker, that other tier, depending on the size of the institution, again, serving companies from $0 to $5 million or 0 to 25, sometimes it's bigger, but usually not that much bigger. They call the business bank. Those people are literally sitting usually over the branch. I mean, physically, they're sitting in a building, typically on a second level. Or if it's an office building, they may have offices in that region. Why? Because that financial institution has those business bankers, called relationship managers mostly, go out and talk to small businesses in the area. It could be a single gas station operator. It could be someone who owns a chain of small stores. It could be a manufacturer. It could be someone who's doing metal stamping. So all sorts of businesses of all sorts of types, including technology companies and software services businesses of all types, can be served by those men and women who sit inside the bank. And what are their roles? Their roles are primarily salespeople. They're called relationship managers. Now, in the best of all worlds, and I'm going to get into that in a few minutes, in the best of all worlds, there's questions coming in, and I'll take them if I can in a minute. But let me just continue with this thought before I jump into the question and answers. To the answers, I'll get them very shortly. Sorry. So, that business banker is literally mostly a salesperson going out and talking to people. Now, bankers don't like to be called salespeople, so they're called relationship managers, but they're salespeople. Now, the best approach, and what all banks like to use, is what they call relationship banking. What does that mean? That means I'm not trying to sell you a product, because if I sell you a product, that product is fungible, meaning it's equivalent to the product the next bank offers. If I offer you a loan, you might say, 3% interest. I don't really like that. And you're charging me 2% fees. I don't really like that. So I'll go to the next guy. So that's not what most relationship bankers do. They want to understand your business. Now, why do they want to understand your business? And I'll show you a framework in a second when we get to larger companies. They want to understand your business so they can really provide you guidance. So you call them up. You, that small business operator, call them up when you have a problem. You've been trying to invest for your children's savings, by the way. That's the personal services. So that you want to buy a building, right? That's when the banker wants to get a phone call. It doesn't want to have to constantly keep calling you. So the best thing that relationship manager can do, and the things that almost all banks train and educate their people to become, is strategic relationship managers. And again, as I said, I'll get into what that means in a second. Let me just take a question that's just come in. Is keeping a deposit in a bank like fixed deposit or recurring deposit as beneficial as investing? Does it have a tax rebate? So the tax rebate I can't answer because it's obviously going to be related to your country, whether you're in Britain or France or India or Australia or the United States or Canada. But what I can say is that typically, as I mentioned before, the least cost capital, meaning the lowest rate of interest for a bank, is the retail branch. Now they've tried to become more competitive to attract more money, but the reality is that's not a great investment, nor is a CD, because again, it's a long CD is a typical investment of a fixed period of time, 60 days, 90 days, 120 days. But CDs do not, certificates of deposit, do not go over a year. But so you can keep money in a bank because you need to be liquid. In the banking world, it's called liquid. You need to have some money because you have to pay your bills, you have to pay your rent or your mortgage, and so in a general context, it's not the best form of investment. And that's why typically what you'll do is open up an investment account. Now I'll talk to that in a second when I get to other financial institutions. So you open an investment account in, it could be the same financial institution. For example, your bank probably has an investment management arm, okay? That was separate. Those were separate by law up until years ago. But now those organizations have separate entities that often offer private banking or consumer investment services. And again, I'll get into the distinction between what is a private banking service versus a consumer. So you and I, mere mortals, are typically going to be dealing with the online systems in the United States, for example, Charles Schwab or Fidelity or TD America or TD Trade, and you'll take some money and open an account there, and then you'll start investing there. That's typically going to be established at the your own level. So again, it's typically not the best return, and it's very simple because the banks are not really positioned. They have so many products they're offering. Most banks have not built out a very sophisticated investment management operation. Now, of course, I'm not talking about J.P. Morgan. I'm not talking about HSBC. I'm not talking about the Commerzbank or the big global banks. They have these sophisticated operations. I'm talking about your average bank that you might walk into in your local town. So typically you will fixed deposits, usually sometimes demand deposits, what they call demand deposits. Fixed deposits don't make much money at all, and the word fixed deposit has mixed meaning, but if you're talking about a deposit in a checking account or even a savings account, they're fundamentally not different. A checking account and a savings account is not different. Often there are checks offered for savings accounts. They're just fundamentally not different. It's a marketing distinction without a difference. Okay, so you're pretty much the same type of account. So, so again, typically you'll invest in other types of things, equities, what we call equities, stocks. You'll invest in mutual funds, which is groups of stocks typically, and other types of instruments, exchange traded funds, all sorts of things, which I'll get into in more sophistication, more depth in a later discussion. But anyway, let me get back to the branch banking. So the branch banker is a salesperson going out trying to understand the client. Now, why does the branch banker want to understand the client? Because, as I said, the branch banker doesn't want to be considered a commodity. The brancher wants to distinguish or stand out from the crowd. And so they really develop a strategic relationship with the client. Now, let me jump into I'm going to jump forward very fast in a bunch of slides, and I'll probably have to, so I'm going to go from the small business, which is all sorts of relatively simple services, to a medium and large sized business. What's happening in medium large sized business? Medium and large sized businesses are bigger, obviously. Medium sized business, again, all defined by the type of institution. Big companies have huge or much greater levels of revenue targets for a medium sized business. A medium sized business in those bigger companies might be $100 million to $2 billion. Now, mere mortals like us would think that's a fair amount of money, right? A lot of money. Maybe Jeff Bezos doesn't consider that a lot of money. Of course, with no disrespect, he does. And I'll get to that later. The wealthiest people consider the smallest amounts of money the most important. Okay, so let's not, let me not divert. In any case, a medium-sized business has different services. Why? It just purchased a piece of equipment for that metal stamping, or the manufacturing, or the making of creams and lotions, and those are expensive. So they need to go into the business banker now learns about your business, understands that you need to, and you had a discussion with them. You need to buy this $100,000 or $500,000 or $2 million piece of equipment, right? So that business banker is thinking, I don't really know much about that. I know it in a broad sense, which is exactly what most of those relationships do, the managers do. Some are more experienced than others, of course, over time. But chance that they will go inside the bank, there are product people, believe it or not, that loan that you might want to take out from the bank is considered a product. Okay, that's what the banks think of it as. So there are product experts inside a financial institution. Those product experts might be involved in real estate. Those might be involved in equipment purchases, different groups of people. Someone who's an expert in real estate is typically not an expert in understanding how to buy what would be machinery and equipment. Okay, so there'll be different underwriters. Okay, so those, I keep on saying okay, I'm sorry. So there will be different underwriters and they'll have different levels of sophisticated experience. So someone just brought up a question, again, this is an open discussion, about the consumer and how are credit scores decided. How does a bank decide the credit scores? Are there any other ways, as we as laymen don't know, that can affect our credit score? Okay, so credit scores. Credit scores are not done by banks. Credit scores are done by rating agencies, consumer rating agencies. Fair Isaac, Experian, TransUnion. There are others, I'm sure, in other countries. Those are I mentioned in the United States. And those credit scores are purely based on your credit history. How often do you pay your bills on time? And what are those people that you pay that to reporting your on-time payments or your late payments to the credit rating agencies? So the credit rating agencies exist to establish these scores from very low in the 400 or 500 area to very high in the 700 and 800 area, and those scores will determine in a consumer case, in consumer lending, whether it's an auto loan or your credit cards. You'll notice your credit card rates are very high if you have a lower score. The rate of interest is very high, and there may be fees to open up the card as well if you have a low score. If you have a high score, they give you the card, they give you credit, they give you a $5, $10, $100,000 line of credit because they want you to spend money, and the rate of interest is low. So in credit scoring, meaning the bank doesn't create the score, bank uses those scores from third parties, those third-party agencies. Now it's an interesting segue, because now let's talk about the small and medium-sized businesses. Okay, small and medium-sized businesses are typically not rated by third parties, like I just mentioned. They're typically not rated by, they're certainly not rated by Fair Isaac and Experian, because those organizations mostly are focused on consumers. There's an organization in the United States called Dun & Bradstreet. Of course, there are others that provide background information to about those companies, and they'll provide their timeliness of payment, similar type of approach to the consumer side. But the reality is most banks certainly in the small area, certainly in the medium-sized area, and as you get larger and you deal with the small companies, they may use Dun & Bradstreet to determine whether they're going to make you a loan. If it's a consumer loan, meaning you own a business, you're a small business owner, and you decide to buy an automobile and you want to lease it or you want to finance it, the bank typically will use your personal credit score. When it comes to lending to the business without a personal guarantee, that is to say you want to buy this equipment and you say, I'm not going to personally guarantee this, which banks often require, they will look at the business. What does that mean? They will look at your financial information. Now, this is where it gets very risky, and that's why the interest rates start to go up for small businesses, because banks have not a lot of information. A small business typically has financial statements, but they're typically prepared for by the owner of the company or an accountant or a bookkeeper, and they're not audited. Those financial statements are, we hope, presented in the best light, by the best and most accurate light by the small business owner, but they're not verified by any third party, such as an auditing firm like PricewaterhouseCoopers, what used to be called PricewaterhouseCoopers, PwC, or a medium-sized regional firm that are firms of 10, 20, 50, 100 accountants. So those statements are typically prepared. Now there's 4 or 5. I'm not going to get into that now, but there's 4 or 5 levels of financial statement review. There's prepared, which is an organization that just prepares them for you. There's reviewed, which they've taken a fairly cursory review. There's compiled, and there's assembled. And I might have gotten them out of order there, but the idea is there's levels of review. When a firm gets larger, it's worth it for the firm to start investing in an audit. Why? Because it provides greater clarity to the financial institutions they deal with, the banks in this case that I'm talking about, that are going to lend them money or provide other services to them. It provides greater clarity and certainty because the auditor, the accountant, has greater liability. They better tell the truth because if they don't, there's financial liability to them. So, as I said before, as you go up the food chain, the consumers have individual credit rating agencies, the small businesses, there are some rating agencies, not that many, but as we go up the food chain, we're getting more and more sophisticated services. Now let's get to the global companies. Global companies have a myriad of services. I always use this example because I hope it provides some clarity. Let's say you're a shipping company, or let's say you run a ferry service, okay, and you decide that you need to buy new ferries. Well, ferries aren't made yesterday, and they don't sit on a shelf in any Walmart or any store anywhere. So those ferries need to be manufactured. So you'll typically, let's go to the old favorite, Holland. You will go to Holland and you will find a great boat manufacturer there. You get them boats made all over the world, of course, but I use that example of the Netherlands. You will have a boat manufactured, and that boat's not going to be $200. It's not going to be $100,000. That boat may be millions of dollars. No, I shouldn't say maybe. It will be millions of dollars these days. Even the smallest boat will be millions of dollars. And don't be surprised if it's 20, 50, $100 million or more. So these boats take time to build. What you'll do is you the individual will enter into a contract with that organization. Chances are you do not have all that money in the bank. And now I'm talking again about medium to large size companies, mostly large size companies. So what they will do, and again, this could be for any product or service. I'm just using a boat as an example, but it's a hard piece of equipment. It will enter into a contract to acquire that boat. Now, most likely it doesn't have the money in the bank. It might have a deposit in the bank, like you'd have a deposit for your home, but it will take that money and it will turn to its bank rather, and it could be, in that case, if I'm a global company, I'm typically dealing with multiple banks. There's no one bank that serves AT&T or think of a European company. One can't come to mind, but Selfridges in the UK. So there's no one bank that serves them. They're very large companies. So there's multiple banks pitching for their business. Those relationship managers that I talked to about before, going out and talking to them. Okay, so the banker will the banker will get information from the company, in this case a shipping company that wanted to buy a ship, and the banker will underwrite that. They'll say, hey, is this a good purchase? Oh yes, we think it's a good purchase, and it's a fair price of $100 million. So banker becomes your partner. The banker actually becomes one that might even help you begin some levels of negotiations. But let's assume, I'm not going to get into that level of sophistication at this moment. The banker says, yes, we will help you buy this $100 million boat, and we will, if you're a huge company and you have a very high credit score, if you will, the bank has scored you. The bank has scored you with its financial analysts internal to the bank. Like I said before, people who are understanding real estate, people understanding, machinery. There's going to be someone inside that bank that helps the relationship manager with a variety of products, as I said before. This product will be a loan. There'll be probably multiple loans, and I'll talk to you about that in a second, or multiple services. One of the services is a loan to purchase the boat. And the banker, in this case, knows your credit, doesn't need a deposit because it's lending money to you all the time for all sorts of needs, and it might fund the entire purchase. It might fund the purchase to you or directly to the manufacturer, but more likely you're not going to pay $100 million up front for a boat. How many of you would if it took you two years to build? So what you're more likely going to do is put a deposit, let's say 10%, $10 million. So you wire transfer, you've got a contract to purchase the boat. It's a reputable organization that's building the boat. You give them $10 million, they get going. Now, there'll likely be so-called progress payments. As you go along, that company's going to say, hey, we've got about 30% of the boat finished, we need another $20 million. You pay $10 million, we need another $20 million, and you'll fund that. So that is how it happens. Your bank helps you, and ultimately you have a loan that has a $10 million loan you draw from the bank, and then a $20 million loan for your bank, et cetera, until you've purchased and fully paid for that piece of property. But of course, that boat. But of course, now you owe money, which you have to pay off. And you'll pay off, again, we'll talk about loan payments, repayments at some point in the future, but you're not going to pay it off in a lump sum because you wouldn't have taken out the loan otherwise, or you're not most likely not going to pay it off in a lump sum. You're mostly, as the business owner, going to pay it off in pieces, in a amortizing loan. You'll pay a little bit in interest and a little bit in principal. And again, I said we'll get into the payment structures of those types of things in the future. But now, what I'm going to do is jump back to the slide again, because I'm going to talk about what happens with these global organizations and the other services that they're purchasing. And many of you heard of things like derivatives. Now, what is a derivative? A derivative is a risk management tool. And as I mentioned before, think about it for a second. You just purchased this boat. It was $100 million. But there's, as we all know, foreign exchange. Interest rate of the euro and the guilder. I don't remember if the guilder's around anymore. But the interest rates of foreign currencies change. The interest rates in countries and the rate of the exchange of foreign currencies changes all the time, daily. It's one of the largest markets, if not the largest market, I believe, in the world. Trillions of dollars are exchanged internationally all the time. So what does that mean? That means the markets are very liquid. That means the markets may also be quite volatile. So my $100 million boat, if I don't play my cards right, might become $105 million because the interest rates in one country in Holland in this case, caused the currency to become more expensive, cheaper for them, more expensive for us. And I go, oh shoot, instead of buying one of their currency, I now have to buy 1.2 of their currency. So even though the price was fixed in dollars in this case, my example, to me, it was not fixed in what I have to pay them. So I'll enter into a swap. Okay, I might enter into a currency swap, which will fix the price. Again, I'm not going to get into Ferris Sa, who is talking about this. And you'll see at the bottom of the screen here, we have, if you look at the bottom of the screen, you'll see we have a Foundations of Banking and Financial Services, which you're going to get into much greater detail, but also in a more structured way. Again, I said this is more of a fireside chat. So again, let me go back to the slide for a second, and I'll take a question that's coming in. Do banks earn money on our deposits? Yes, of course. A bank earns money on your deposits because it borrows money from you. That's a liability. Most people don't think of this as such. When you put your money in a bank, it's on the balance sheet of the bank as a liability. Therefore, they have to do something with that liability. And oh, by the way, you know what they might have done? They might have invested it in that boat. Think about that for a second. So your money sitting in a bank is invested in a myriad of things. And I say in that boat, it's probably not that boat, because if it did take your money and put it in that boat, you were not going to get that back until the revenues of that boat started coming to you. So what did the bank do? It took your money. Money is fungible. That term means it can be swapped. So the $1,000 you put in, or the 1 lakh rupees that you put in your bank, is going to be used by that bank for a myriad of purposes. Making loans to companies, making loans to other consumers, buying real estate, making loans to other financial institutions. So there's a myriad of things it does, but it needs to maintain liquidity. The bank needs to maintain liquidity to get you your money back when you go into the branch. And I'll get to that also in a second. So yes, they absolutely make money. They make a spread. Buy low, sell high, right? So they're buying low from you at a low interest rate relative to the market, and they're lending it out at a higher rate to someone who wants to buy a boat, or to someone who is no longer, so now there's someone who needs credit in a credit card. So they'll be lending it out in that way as well. Are third-party credit scores rating companies reliable? Well, that's very debatable. And we have we've had a discussion about payments at a more sophisticated level in one of our other talks, but we'll get into that. They are what they are, as some people say. So there are a myriad of things. People know how to game them. As someone, as we had a discussion in our last talk, there are people who scam right? We all know that. And they can fabricate a very high credit score. So they're credit advisory firms. There's lots of information on the internet about how to improve your score. Mostly it's pay your bills on time and take out enough credit that you need and then expand your credit. And again, I'm not an expert in consumer credit, but for sure, there's those rating agency scores are only as reliable as you spend time managing it. So if you want to improve your credit rating, manage your credit. It's a very basic thing. Same thing for a business, small business, medium-sized business, large business. If you want to maintain your credibility and credit, therefore be able to buy a car at a lower rate of interest, therefore at a huge company borrow money at a lower rate of interest, or enter into all sorts of swap agreements and other types of sophisticated things at lower costs, you will most certainly maintain and be vigilant to your credit. I was having a discussion the other day with a fellow in Cyprus, yesterday actually, in Cyprus, who is running a school of about 100 students, and they're interested in having financial literacy courses, which we can help them design for their students, aged from 10 to 17. And I recommended breaking it down to four groups, based on the age group, so that someone at a young age begins to understand what is money. As I used to tell my kids, money's an idea. It's an agreement. Okay? So we can start at the very simplest levels, get to the most sophisticated levels, and the point is that you need to understand it because it's a very important part of your life. Whether you don't care about it, that's fine. Whether you value it for what it can buy you, hopefully not just money in and of itself. And I say buy you, do for you. I don't think of having wealth as wealth for its own sake. Some people buy fancy gold cars. Other people decide that they're going to use their wealth for good. Look at Bill Gates as an example, an excellent example of someone who's taken massive wealth and turned that into very good things, charitably, around the world. Now, I'm not going to get into any politics about vaccines, but I can tell you that malaria has been largely addressed. I won't say fixed, but addressed. All sorts of things around the world are done by people with enormous wealth. Sometimes they do it and they want to put their name on a building, and that makes them feel good. And sometimes they do it because they just want to do good. And I think there are many foundations, the Warren Buffetts of the world, and many other people, and Jeff Bezos as well, do fantastically valuable things. So, can I study about these things for a job? If so, where do I get the study material? Well, the fact is we do that online. If you look at our platform, one of the great distinctions is between our platform and others is, and I say this rather simply, if you look at what behind me, you will see a digital library. I've not read one of those books. Now, what the great part about some platforms is you get very inexpensive books or digital recordings of people teaching. There's a very simple truth to that. If I ever ask anyone what was their most valuable educational experience, whether in grade school, whether in college, whether they never went to college and in the work world, whether they from their parents, what was the best educational experience? Think about it for a second. For sure, it was not studying in the library. Now, that does not mean a library is not a great place to study. I spent hours and hours and hours in a library. But I also will tell you that one of the best experiences I ever had, and probably the best experience, was from an instructor who happened to have been a friend of Einstein. And he has a brilliant instructor and is very inspirational about, in this case, invention and discovery in the arts and sciences. So it will be an inspirational instructor. It'll be an inspirational parent. It'll be someone, as a woman told me the other day, her best experience, or most inspirational and most valuable educational experience that she could remember, was as a kid learning about archaeology by their the instructors, the teachers, hiding things in a sand and under rocks, and the kids learn to understand how to excavate or to do archaeological digs. So almost always, I'm wandering, but I want to get to a point. The point is, video online is excellent. It's a fantastic way of learning. But the way we believe education needs to be done, it needs to be done with live instructors, and we have a global footprint of many, many hundreds of instructors, top experts in their field. If you're an instructor and listening to this, sign onto our platform and click Teach with Starweaver. But the real way you're going to learn is by project-based learning. The real way you're going to learn is based with other instructors. If you went to college, your real way you learn was either sitting in it. You may have learned by the lecturer or the instructor teaching, but more likely, you didn't get a chance to ask a question. There were 250 people in the class, but you went to a recitation, what we in the United States call recitation, a breakout, where a PhD student typically, or a master's student, really knows the subject well and works with you through a project. If you're a developer or if you're someone looking to get into the cloud, sure, there's recorded courses on the cloud. And yes, we have lots of them. And you can get certification programs, but it's going to be very hard for you to really learn that material unless you work on a project, unless you get involved in a lab is one thing that's helpful. It's enormously helpful. Learning by doing, yes. But if you're doing it by yourself, it's usually going to go in one ear and out the other. I used to have all of the most senior level securities licenses in the United States. Series 24 was the top one at the time, where you could manage an investment bank. But the truth of the matter is, the real truth, as I studied for that exam, I passed the exam the first time, which is often a very hard thing, by the way, and I forgot everything I knew the minute I finished the exam. So if you're going to take an Azure or an AWS or a GCP, Google Cloud certification, it's great. But if you want to be effective and you want to prove your net worth in a business, then you're going to want to learn how to do things and work on projects. So I think I'm going to wrap up now. I'm going to have many more of these programs in the future. I really do. I was going to get into so many other things. You really can't do it in half an hour or so. I probably have gone long. Yep, I went 40 minutes, but nevertheless, I'm going to do more of these, and I hope that you come back. I hope you subscribe to our platform. There's a free version. Sign up for free. You'll be able to attend these Meet the Gurus for free. There are other things you'll need to pay for because we need to make a living as well. But we are trying to provide a lot of value to you up front. We want to provide a lot of information and insight. I'm a person who's had an extensive financial background. If you look under my background on Amazon, you'll see many books, okay, which I've been editor of, some of which I've written and co-authored. But the reality is, I want to provide value to you, whether it's in technology, which we have people who will be talking about, whether we talk about payments, whether we talk about Agile. Kelly O'Connell did a fantastic program on Agile. You'll get that. So jump onto the platform. We appreciate your time, and see you next time. And if you hang out, you'll get a 50% discount. Use the code at the end of this. And again, follow us on social media. I always love when people say, and click the like button. Heard something yesterday, it's very important. And put comments. Put comments in our recording of these things on social media, because then we can answer them. We can understand what we're doing right, what we're doing wrong. And my goal here is to provide education. It's one of the most fun businesses to be in. It's one of the greatest ways you can spread knowledge and elevate people. And Derek Bach from Harvard is once the Harvard president or chancellor. I've forgotten exactly what his title was. He said, if you think education is expensive, try ignorance. So our platform is very inexpensive. It's about engaging you with live instructors, people like me, in their own subject areas of expertise. Again, like us, subscribe to the platform, sign up for the Foundations of Banking and Financial Services program, and see you next time on another Meet the Gurus with subjects like finance, project management, technology, etc. Have a great day.